It's almost a 2-for-1 day today. We've got a podcast out in the morning, but after watching my UBS stock get crushed a bit today, I wanted to talk about what happened on the markets and link it back to fundamental valuation. The Federal Reserve just dropped a bombshell that's sending shockwaves through the global economy. A tiny shift in their policy has triggered a massive repricing across asset classes worldwide.
Wow, that sounds like a big deal. What exactly did the Fed do to cause such a stir?
Well, it all comes down to their recent guidance on interest rates. They delivered a 25 basis point cut, but here's the kicker. They've adjusted their forward guidance to project only 50 basis points of cuts in 2025, down from the previous 100 basis points. This might sound like small potatoes, but in the financial world, it's like they've just changed the rules of the game.
So they're basically saying they'll keep rates higher for longer than everyone expected.
Exactly. And the market's reaction was swift and dramatic. The yield on 10-year US Treasury surged 20 basis points in just 2 days, reaching 4.59%, the highest level since May. To put that in perspective, it's like if the price of gas suddenly jumped 20 cents overnight. You definitely feel that at the pump, right?
Oh, for sure. But why does this Treasury yield matter so much?
Great question. See, the 10-year Treasury yield is considered a risk-free rate proxy and serves as a benchmark for many other interest rates in the US economy. When it moves significantly, it forces a repricing of risk premiums across all asset classes and geographies. It's like dropping a stone in a pond. The ripples spread out and affect everything.
So this isn't just about Wall Street then. How might this affect everyday people?
Well, it can impact a lot of things. Mortgage rates might stay higher for longer, affecting the housing market. Car loans could become more expensive. Even the strength of the dollar when you travel abroad could be affected. It's a classic case of how decisions made in Washington can trickle down to Main Street.
That's fascinating. You mentioned inflation earlier. Is that still a concern?
Oh, absolutely. In fact, recent data shows core PCE and CPI readings exceeding consensus forecasts. But here's the interesting part. It's not just the headline numbers that matter. The composition of inflation is crucial. We're seeing particular persistence in services inflation and shelter costs, which typically demonstrate higher autocorrelation and slower response to monetary policy.
That sounds complicated. Can you break that down a bit?
Sure thing. Think of it like a stubborn stain on your favorite shirt. You wash it, but it keeps coming back. That's what's happening with certain types of inflation. They're not responding to the Fed's washing as quickly as hoped. This persistence is making the Fed rethink how high interest rates need to be to keep the economy in balance.
I see. So how is this affecting different types of investments?
Well, that's where it gets really interesting. There's this conventional wisdom that lower rates automatically mean higher valuations, especially for stocks. And this is a big, but we need to consider both the discount rate effect and the growth expectations effect. The Fed's messaging suggests that while rates might be lower, the path to those lower rates might involve more economic deceleration than previously anticipated.
Oh, so it's not as simple as lower rates equal higher stock prices?
Exactly. It's like being offered a great deal on a car, but then finding out the reason it's so cheap is that it has engine problems. The low price might be tempting, but you have to consider why it's low in the first place. This creates what I call a valuation paradox. Lower rates in this context might actually justify lower, not higher, multiples because of the implied growth deterioration.
That's really interesting. How are investors reacting to this?
Well, we're seeing some fascinating sector rotation patterns. Defensive sectors, think utilities or consumer staples, are outperforming despite the prospect of lower rates. It just goes to show how complex these market dynamics can be. And it's not just stocks. This is affecting bonds, currencies, and even emerging markets.
Wow, it sounds like this Fed decision is having far-reaching consequences. What should people be watching out for in the coming weeks and months?
Great question. I'd say keep an eye on a few key indicators. First, watch the evolution of market implied inflation expectations across different tenors. This can give us insight into whether people think the Fed will be successful in bringing inflation down. Also, pay attention to changes in cross-currency basis swap spreads. These can indicate stress in global dollar funding markets.
Those sound like pretty technical indicators. Anything more accessible for the average person?
Absolutely. Watch for changes in mortgage rates. That's something that affects a lot of people directly. Also, keep an eye on the stock market, particularly how different sectors perform. And don't forget about the price of everyday goods. If you start noticing prices at the grocery store stabilizing, that could be a sign that the Fed's policies are having their intended effect.
This has been incredibly informative. Any final thoughts for our listeners?
Yeah, I think the key takeaway is that while these financial dynamics might seem abstract, they have real-world impacts on all of us. Understanding these relationships, even at a basic level, can help us make more informed decisions about our own finances. And remember, economics isn't just about numbers. It's about human behavior and decision-making on a grand scale. It's a constantly evolving story that affects us all.
Well said. Thanks for breaking this down for us today.
My pleasure. And to our listeners, keep watching, keep learning. And remember, in the world of finance, change is the only constant. But just before you all shoot off, I need to do my plug. I want to share something that combines my passion for markets with the power of modern technology. Throughout my career on Wall Street, where I was ranked the #1 analyst by Institutional Investor 10 times, I've always believed that institutional level investment knowledge should be accessible to everyone. That's why I created Insight One. Insight One is where my decades of market expertise meets cutting-edge educational technology. We've taken everything I've learned analyzing markets and working with major financial institutions and transformed it into an interactive learning experience. The platform uses advanced technology to adapt how this knowledge is delivered, making complex investment concepts clear and actionable for every type of learner. This fusion of deep market wisdom and sophisticated edtech is what makes Insight One unique. Whether you're just starting your investment journey or looking to sharpen your skills, you'll have access to the same level of analysis and insights that I provided to institutional investors throughout my career. You can find us on the App Store, on Google Play, or on our website, theinvestmentanalyst.com. So start your journey. Thanks for listening, and I'll see you next time.